Welcome, everybody. Today, we get to talk about a very important foundation of building a business. What's the actual business model, the legal structure that we're going to utilize? We're lucky to be joined by Doug Bent. Doug, so great to have you.
Thank you for having me.
So, Doug, what are we talking about today? I mean, I can speak about it from a business coach perspective, but from an attorney, why is it so important for somebody to pick the right model?
Well, I think it has a few different impacts on a business. First of all, is understanding that different entities have different tax ramifications. And so selecting an entity that will hopefully really optimize your tax situation for you and your business. And secondarily, liability protection to help protect your personal assets. And then lastly, particularly if you're bringing on other individuals and you want to incentivize them with equity in your company, thinking about what type of entity structure might be the best fit for you and your business.
Perfect. Well said. So I look forward to diving into each of those and the different models. But before we do that, please tell us a little bit more about you, your background, your firm.
Sure, I'd be happy to. So originally grew up in Nebraska. I've been out in San Francisco now for about 10 years. And the law firm focuses exclusively on helping out entrepreneurs on transactional business matters. And so a key part of that is we help set up over 50 legal entities a year and helping clients really select what's going to be the best legal entity for them and their business. And from there, serving as their outside general counsel as they grow and expand their business.
Perfect. So of those 50 that you work with, I mean, what makes somebody a perfect fit to be one of those 50? Who are you looking for? And who's looking for you?
Yeah, I think, for us, it's really about, it's all about a fit. Whether you're hiring a business coach such as yourself, a CPA, a business banker, or a business lawyer like us, it's all about fit. And a big part of that fit is expertise and really finding an attorney that really has done your project, not one or two times a year, but ideally dozens of times a year, so they can add the most value to you and to your business. And for us, one of our niches is helping clients really go through a choose your own adventure of deciding, one, is any sort of legal entity make sense for your business, or should you stay as sole proprietorship? And two, if you decide to set up a legal entity, what type of legal entity might be the best fit?
Perfect. So let's go ahead and jump through. What are those main legal entities? What's the list?
Sure. So, for most business owners, they're looking at either a sole proprietorship, a limited liability company, aka LLC, a corporation, and then from there you have various tax elections that you can make, either a C corporation or an S corporation.
I love it. So let's go through those one by one. I mean, sole proprietorship is the easiest to set up. So can you tell us a little bit about how and why somebody would do a sole proprietorship to start?
Sure. So sole proprietorship, that's your default. So if you do nothing at all, you're a sole proprietorship. So talk about easy. It doesn't get much easier than that. Same with a partnership. If you have more than one business owner, your default, if you do nothing at all, is your partnership. So a lot of people say, hey, look, well, that sounds great. I like easy. Why not just be a sole proprietorship? Why not just be a partnership? And I think it's thinking about there's drawbacks to being a sole proprietorship and to being a partnership.
Let's talk about those.
Yeah, so the biggest drawback really is liability exposure. And so if you're a sole proprietorship or you're a partnership, if something happens in your business and your business is sued, you can be held personally liable for that successful lawsuit. And so for a lot of business owners, they can get some protection through insurance, but there's concerns about insurance. Everyone should have insurance, don't get me wrong, but there's a reason why those policies are 40 pages long. They're filled with exceptions. So, my ideal insurance policy would be a page long. It would be, I pay this premium every year. In exchange for paying that premium, the insurance company has my back for up to X amount. But the policies instead are dozens of pages long and they're filled with exceptions. And so if you are a sole proprietorship or a partnership just relying on your insurance policy, there's risk there that the claim may fall outside the bounds of your policy. And so you could still be held personally liable for that claim. Secondarily, there's limits on the policy. And so if you could have a $1 million policy and something really bad happens in your business and you lose a $3 million lawsuit, even if that insurance policy picks up the first $1 million in coverage, you're still on the hook for the balance, the $2 million balance. And so while, the sole proprietorship and partnership, the big advantage is that it's so simple to set up, it's so simple to maintain. A big drawback is the potential liability exposure there for the business. And the other big item too is that for some business owners, they can also have tax benefits in addition to the liability protection benefits of instead setting up a legal entity.
I'm really excited to talk about that. And one thing I'd like to frame very carefully, and one of the things I really admire, just your audience, about Doug and his firm is they make things simple and not simplistic, but they really make sure that it's something that people can understand and they don't get lost in the weeds. I mean, let's be candid. I think a lot of people misunderstand the whole limited liability capacity, and they're just trying to completely protect them from any litigation whatsoever. But I mean, correct me if I'm wrong, that's unrealistic because anybody can sue anybody for anything at any time. So let's frame that a little bit. I love the way you say it, of what are people trying to prevent when it comes to just going to court?
Yeah, unfortunately, we live in a system that really incentivizes plaintiffs. And so, I think if you're in business, unfortunately, it's more of a question of when you're going to be threatened with a lawsuit and not if. And if you're in business long enough, even if you're doing great work, at some point you're going to either mess up. Hey, we're all human. Or you're going to have someone that has unreasonable expectations of what you should be providing. And so I think planning for that in advance and just figuring it's going to happen and how to best protect yourself for when that happens is the best course to take. And for us, we think about it really in terms of 4 layers of protection. And so first you have customer service. And so the least expensive legal bills you'll ever pay is when a customer is unhappy, being more lenient on writing some of that bill off, maybe comping them some time, comping them some product. And you may also turn what would have been a 1-star Yelp review into a 5-star Yelp review. And so really thinking about, okay, look, I may not completely agree with this person, but I just really would rather have it go away and to make them happy. And so maybe I'll write off a little bit of time. If they're still unhappy, hopefully you have some sort of contract in place with the client. And so if you're a service-based business like yourself providing services, you have a contract outlining really what the expectations are of both parties and when something bad happens, how that plays out. So there's a game plan in place. But if the contract doesn't cover you properly, hopefully you have some sort of insurance policy that steps up, covers you and your business. And then lastly, perhaps you have a legal entity in place to create a final backstop between those business activities and your own personal assets.
So well said. And that's something that I'm really glad we can talk about here and make it really clear. Some people think, okay, just because I have an LLC or some of the other structures we'll talk about, I'm permanently protected, but it's just not the case. And that's something where those other 3 layers you talked about are so important as a preventative measure, just to make sure that we minimize the likelihood of something like that happening. And also just do good business. I mean, like you said, and one of the things that I really admire in opportunities of an unhappy customer is that we can really establish a brand, we can establish a relationship, because when we've interacted with somebody and something went wrong and they made sure that we were still taken care of, that builds an enormous amount of goodwill and credibility. When ironically, a situation where things always go perfectly, we don't know how they would handle it if things didn't go well. So I like the way that this structure can be interwoven into just running a really good business. Any thoughts on that?
That's spot on. And I think, when I talk to business litigators in the Bay Area, they say to defend a lawsuit in the Bay Area, you're looking often at 6 figures. And so a few times a year, we'll get calls from clients saying, I did nothing wrong. And this person is claiming that I owe them, $50,000, $60,000. And, I've always looked for a better way to frame it than the sweet spot, because it's not sweet at all. The difficult position that those clients often are in is that you could take this to distance, you can win the lawsuit in quotes, you may spend more money on lawyer fees defending yourself to get that win than to pay them out and have some sort of settlement amount. And they're very frustrated to have to pay that money out. And so, really, having an insurance policy, doing like a once a year check-in with your insurance broker, hopefully they're being proactive and they're reaching out to you once a year, but if not, you should set a calendar alert, reach out to them. Talk about changes in your business. Talk about what is keeping you up at night? What are you really worried about? If X happens, does your current policy cover X? And if not, what type of coverage should you get to cover X to help you sleep better at night and cover that type of incident if it occurs?
I love it. And it's too easy to just hope it doesn't happen. But there's this calm that I know you've felt, that I felt, that I hope a lot of people in the audience have felt in some way, shape, or form. When we actually have had that conversation of what's the worst that could happen and how can I make sure that I'm as covered as I can be, there's this calm, this ease that settles in that just allows us to focus on really just doing good work, which I would argue is such a big part of just running an effective business. Before we transition from sole proprietorship and partnership to the other structures, I want to talk about a different kind of insurance policy that I know you can help with, which is making sure that the parties involved have an agreement. Can you tell me a little bit more about how that works for sole proprietorships and partnerships? And I think that'll be a good segue.
Sure, absolutely. So I think of 2 types of agreements. I think about internal agreements among, co-owners, and I think about agreements with third parties. And so when it comes to an agreement in a partnership, ideally it's a legal game plan, and it does a few different things. One, it outlines what the expectations are for both parties. If you're signing a partnership agreement, really any agreement, ideally you actually, God forbid, understand what's in that agreement. You can read it and understand what you're agreeing to. If there's anything in that agreement where there's not alignment, catching that up on the front end instead of waiting till something bad happens and having there be a dispute among the parties or with another party. So I think really having an agreement that outlines, what the expectations are, including, how are you going to split profits? How are decisions going to be made? Particularly if you have co-owners, regardless of whether it's a partnership, an LLC, and you have a 50-50 ownership structure, the default is that, unanimous consent. Otherwise, nothing happens. And some clients are okay with that. They say, hey, look, unless I'm on board, I don't want something to happen. Other clients say, look, that can lead to deadlock, that can lead to inaction. So let's think about some other potential solutions there for what happens when we aren't in alignment.
Yeah. Do you have any good examples of that, of situations where the company was either in deadlock due to 50-50 or thanks to somebody having more than 50% they can move through? What are some things that people tend to disagree on?
Yeah, so I think a good example is a few years ago, we had a client. It was 50-50 ownership. They had several locations. They hired one of their really good friends to be the office manager, kind of running the COO, if you will, running the day-to-day operations. And I don't use the word hate lightly, but the other owner turned out to hate this person. I mean, really couldn't be in the same room as this person. And so it really what it came down to is one day he would fire her. The next day, the other person would hire her back. And this went back and forth. And you got in this big dispute over this person, ended up changing the locks on the different locations. They got into a lawsuit. And in the meantime, the business is withering on the vine, right? Because it's not only the financial money that they're putting into lawyers to resolve this, but it's also the emotional energy that you're expending to sort out how you're going to make this situation right for both parties. So I think, thinking through ahead of time of saying, hey, look, maybe we should have some sort of other pressure gauge to kind of let that off, the steam off ahead of time. When that happens, it could be a good idea for people.
That's fantastic. And I think that's one of the many ways that an attorney like yourself and your firm can come in there and help ask those questions ahead of time, because again, it's so easy to just hope that nothing like that ever happens, but instead to have an explicit protocol that we can use in order to just see it through and really make it not as big of an issue as it could be. Like you said, allows us to make sure that the business, rather than wither on the vine, really can still thrive despite the threats that'll come along no matter what. So when it comes to transitioning from sole proprietorship or partnership to an LLC, LLP, S Corp, C Corp, let's talk about that line, so to say, that limited liability. I think a lot of people have a tough understanding of what exactly that means. So what happens if somebody utilizes that limited liability?
Yeah, I think we typically see one of three triggers when people make that jump from being a sole proprietorship to being or a partnership to being a legal entity. One trigger is that they either have a big scare, someone threatens with a lawsuit and they say, hey, I've been thinking about doing this for a few years. Maybe I finally need to make that jump, or they're signing a big contract. And so it's okay, up until now, my contracts have been relatively small, but now I'm doing a deal with Google, Facebook, fill in the blank. And they decide, they want that liability protection because the risk exposure there for themselves as an individual is so much higher. So that's one trigger that we see. The second trigger is that for taxes, we get a lot of referrals from CPAs because people this time of year are sitting down with their CPAs. And sometimes as a sole proprietorship or as a partnership, their effective tax rate can be 50 or 60%. And they see this tax bill that they owe and they say, CPA, help me, what's going on here? How can I make this better? And for reasons we'll discuss, sometimes forming an entity that makes a S Corp election can save them money in taxes. So that's usually the second trigger that we see. And then, other times they're bringing on people that are joining the business they want to give equity to in the business. And you really can't give equity like in a sole proprietorship. The sole proprietorship is you, right? You can't really give a piece of you. And so having a legal entity where you can give someone equity that perhaps vests over time, that they can earn over time, is another reason why we see people form a legal entity.
I love it. Those three are so clear. There's the big scare, there's taxes, and then there's adding more people. Is there a point, let's say the big scare, for example, at which it's too late? Let's say you have an entity and you're looking to transition to a different one. Some people might be curious about, okay, well, is the contract with the previous entity? Is it with a new one? Are they separate? Is it the same? Can you talk a little bit more about that?
Yeah, if you sign a contract on behalf of yourself as a sole proprietorship, and then you get served with a lawsuit, it's too late to go form a legal entity that will protect yourself, right? And so I think it's kind of having the, thinking ahead of saying, okay, look, like this is a more risky area that I've gotten into the past, or this is a much bigger contract than what I'm used to signing. And so I finally want to go ahead and make that step. Now, if you're a sole proprietorship and you transition to being a legal entity, you can ask your clients to update the contract that they have with you and for it to be on behalf of your legal entity. So moving forward from that point in time, it's with the legal entity to provide yourself with that protection.
That makes a lot of sense. So with taxes as well, where's the cutoff there for the new legal entity essentially being taxed as this other form instead of a sole proprietorship or partnership? I know you're not a CPA, but can you speak to
Sure.
that?
I've been on a lot of calls with them. And by all means, like, with the legal stuff we're talking about, the tax stuff, you should talk with your own advisors about what situation fits your business the best. But for taxes, it's, the date that we filed to create the legal entity. That's the first consideration. And secondarily, if you're making a tax election, when you file that form, you indicate in that form the effective date of when that tax election will take place.
That makes sense. So with that last one, with having people join the team, I assume that you need to have the entity set up essentially before you have that contract signed, whether they're employed or somehow a partnership in the group, correct?
That's right. And up until then, you can do other things. So for example, you could have a part of their compensation could be incentive based. And so let's say they're joining your sole proprietorship. You're not yet ready to make the jump over to having a legal entity. Well, maybe that contract with that provider can provide that 10% of the business they bring in, they get that in a commission check. So there's other things you can do to incentivize them, that their incentives are aligned with the business. But when it comes to actually giving them equity in the business, the legal entity should already be formed.
Perfect. So let's go ahead and start talking about that. What are these other structures besides sole proprietorship and partnership?
Sure. And I mean, we try to make this stuff as fun as we can, which is challenging. The way I look at it is really a choose your own adventure. And really the first fork in the road is, does it make sense to be a legal entity at all? And then from there, what type of legal entity? And for us, it's very much a cost benefit analysis of helping the client analyze what are the ongoing costs of forming the legal entity, what are the upfront costs of forming the legal entity, and then what are the benefits? And at what point does that scale tip? And so for us, you ask the CPA the same question, you get 10 different answers. It's probably also true with attorneys. But some of the CPAs we talk about with is that for a service-based business, if they're netting at least $70,000 a year or more, at that point, it may make sense to form a legal entity that elects to be taxed as an S corporation, because the tax benefits of being an S corporation will offset the additional expenses of being an S corporation, and everything else is gravy. The liability protection and being able to give equity to other people, those are just added benefits. So kind of it's a back of the head trigger of when you should be at least talking to your CPA about whether this may make sense for you. I'd say if you're netting $70,000 a year or more, or if you have a really strong third and fourth quarter and you say, hey, look, kind of, forecasting this out over the next year, I consider my third and fourth quarter numbers to be more representative of what my business will be moving forward. And so perhaps I should make that S Corp tax election starting January 1 moving forward for the upcoming tax year.
I love it. So to be really clear, who can take that S Corp election? Is it an LLC, C Corp?
Yeah, so the S Corp tax election is an election you file with the IRS. And so either a corporation can make that S Corp tax election or an LLC can make the same S Corp tax election. Either way, you're taxed exactly the same. You file the same annual tax return every year. It's 1120S, on the federal level. Either it's an LLC that makes that election or the corporation that makes that election.
And I love that line that you draw. At this point, it makes more sense to have yourself be classified as an S Corp. Strange question, but is there a point at which it no longer makes sense to have yourself be taxed as an S Corp with the IRS?
Sure. I think if your revenue significantly drops, and so if you are kind of on that cusp and you're netting $70,000 a year or more, and you have a significant drop in revenue, maybe you go work for somebody else, at least part-time, and it's a part-time W-2 employee. So you're not seeing those tax savings there that make up for the additional cost of having the S Corp. And then at that point in time, I think you take a look at it and say, okay, this S Corp isn't paying for itself anymore in tax savings. Do I still want it? I mean, does the liability protection, do I get enough benefit from that I still want it? Or for some of our clients, particularly when they start doing business with bigger players, they feel there's a marketing advantage there for being a legal entity. And so if you're doing a contract with the Googles of the world, signing that contract on behalf of ABC Incorporated or ABC LLC, maybe they take you a little more seriously than signing the contract on behalf of Doug Bend, right? So for some of our clients, they see a marketing advantage there. So even if there's not the tax benefits, the ongoing tax benefits of the revenue drops, perhaps those other benefits still make sense to keep the entity in place.
That makes a lot of sense. And we'll talk a little bit about what it means to wrap up these entities. I guess that's a good way to wrap up this conversation. But if a company elects to be taxed as an S Corp, am I right in saying that that's really nobody else's business but yours and the IRS and your CPA?
That's right. Yep.
So when people say that they're an S Corp, what do they mean?
They mean that they have formed either an LLC or a corporation. They have then elected to have that entity taxed as an S corporation. It's Form 2553 with the IRS. It's a 4-page form. It's very, very short. And so they decided to say, hey, look, I want to change this tax ballgame, right? And so if you don't make that tax election and you're an LLC, you're taxed exactly the same as how you're taxed as a sole proprietorship. By making that tax election, it changes how you're taxed. And for some companies that are having enough net revenue, it can have additional tax savings for you.
Perfect. So I guess let's distinguish then. If an LLC or a C Corp can elect to be taxed as an S Corp, that means that they're earning more than $75,000 net. What's the advantage to having an LLC that files as an S Corp or a C Corp that files as an S Corp?
Sure. So the advantage to an LLC is that it's a little simpler to maintain. And so with the corporation, you have to have annual shareholder meeting minutes. You have to have an annual board of directors meeting minutes. You have to file a statement of information every year. And so there's some additional housekeeping that comes along with having a corporation to properly maintain the corporation. Where with an LLC, you don't have the requirement to have an annual shareholders meeting, to have an annual board of directors meeting. And the statement of information has to be filed every other year instead of every year. And so a question that we often get is like, okay, then why in the world would I want to form a corporation that makes tax an S Corp if it's easier to form an LLC that's taxed as an S corporation? And really, it comes down to this. Most states, the liability protection is the same, regardless of whether you're a single shareholder corporation or you're a single member LLC. That provide you with an equal amount of liability protection. California, we like to do things differently here. And we're a minority rule state in regards to judges are more likely to pick on single member LLCs and pierce that corporate veil to get at an individual single member LLC's personal assets than they are a single shareholder corporation. And so if you are the only owner in the business and you're worried about that, you really can do two things. You can say, hey, look, I'm going to have a second owner. They're not picking on multi-owner LLCs, just single-owner LLCs. So you say, I'm going to have a second owner in the LLC. It could be a very small position, maybe 1% to 3%, maybe an advisor, right? And by doing that, I kind of address that concern for the additional liability exposure. Or you know what? I'm just going to be a corporation that makes the S Corp tax election, and those additional extra steps, they're not that bad. When you do your first set of board meeting minutes, every year thereafter, a lot of that information doesn't need to change. And so for the extra half an hour to hour a year, they'd rather just have that extra liability protection than have to worry about being a single member LLC.
I love it. So what we're going to do in a minute is kind of map out a little bit of a flow chart of decisions that lead to which entities make sense based on our conversation so far. I want to talk about a couple key things, one of which you said and one of which I want to bring up. Going backwards, the one that I want to bring up is the concept of double taxation. And again, I know it's more of a CPA conversation. Can you explain it just at a high level? It's a disadvantage of a corporation, am I right?
Sure, it's a disadvantage certainly of a C corporation. So once you make that S Corp tax election, you don't have that double layer of taxation that you have with a C corporation. But if you're a C corporation, you get taxed both at the entity level, at the corporate level, and also at the individual level if and when that corporation makes distribution payments to the shareholders.
Perfect. And then the other concept that you brought up is the idea of piercing the corporate veil. What exactly does that mean?
Yeah, so piercing the corporate veil means that you have a legal entity in place, you're sued, knock on wood, and what the plaintiff often does is that they name everybody in that lawsuit. They name your legal entity, they name you as an individual, and then you as a defendant say, hey, look, judge, like I set up this legal entity. I shouldn't be sued as an individual. I signed the contract on behalf of the legal entity, so they shouldn't be able to get at my personal assets. Now, when do judges get annoyed, get upset, however you want to put it, and allow the plaintiff to actually pierce that corporate veil and to get at the individual's personal assets? Really, it's one of three things. The first is that the entity wasn't properly set up, and so they didn't get a city business license. They didn't register fictitious business names. And the plaintiff says, hey, look, they shouldn't be provided the protection of this entity. they didn't do this basic formation work. And so I should be able to get their personal assets because it's one and the same person. Why should they get the protections of an entity that wasn't properly set up? Secondarily, they haven't been maintaining the entity. And so if you're not filing your statement of information, you're not making your annual franchise taxes, well, at some point you'll be suspended, and if you're suspended, your legal entity will not be providing you with any sort of legal protection for the contracts that you signed while you've been suspended. So that's a second reason. And the last reason is that if you're commingling funds. And so what does commingling funds mean? Commingling funds means that you don't have a separate business checking account for your business. You don't have a separate credit card for your business. It's all one and the same. You're running the personal assets through the business assets and the revenue and vice versa. Then the plaintiff said, hey, look, again, it's one and the same person. Why they should be provided with liability protection when they didn't have a separate business bank account? It's all been commingled. I should be able to get it both.
I love that distinction there because, and there are ways to set up a business that are easy and often marketed as very easy that can set us up to have that corporate veil be very easily pierced. But I also want to be really clear, and tell me if you agree here, if somebody even sets it up with somebody like you and does a really good job from the attorney side, if they don't follow those rules, then it's really tough to still maintain that limited liability. So that's a great checklist. I know there are more things that you can share that really allows somebody to protect that protection of themselves. Am I right?
Yeah, that's spot on. And one of the things that we do is that when we form an entity, the last step is to send the client an entity maintenance checklist. Essentially saying, hey, these are the 5 things you need to be doing each and every year. Here's the deadline. This is when you need to be doing it by. Because when we inherit a client, when a client comes over from us that had previous counsel, what we see all too often is that maybe that client had a good foundation for when the entity was formed, but they haven't been doing those things. And they, we had a new client this week that their entity had been deactivated, and so they're raising around the assets raised around a capital, and the entity is not even active because they haven't filed their annual franchise tax payments for the last 2 years. And so I think making sure you properly set up, and then from there making sure you do those things each and every year to make sure your entity is active, and that if something occurs, you're provided that protection.
So if things go wrong and the corporate veil is pierced, that means that instead of the company just getting sued and the assets of the company really being what's making that person whole, if that person doesn't, if the court case doesn't go their way, means that then it also includes their personal assets. They can take their house, their personal bank accounts, all of that. So that piercing the corporate veil is something very much to avoid. But let's talk about just what happens if it actually is maintained. So if an entity is sued, and again, heaven forbid, hopefully this doesn't happen, and they don't make it, and the judge says, okay, we're going to take X amount of assets, maybe it's more than the company has. What happens there? And what is the whole thing that this protection is provided, this limited liability, lacking of the corporate veil piercing? Yeah,
so if you lose a lawsuit, the plaintiff has a judgment, and they try to collect on that judgment. And so if you have insurance that covers that claim, they'll try to get proceeds from the insurance company. If those don't cover the judgment amount, they'll go after the assets of the business. They'll try to put liens on the company's bank account, go after the other physical assets of your business. And if you properly form the entity, you properly maintain the entity, one of the biggest benefits of having legal entities in place is that it creates this legal backstop, this barrier, if you will, a shield that at the worst case scenario, it blocks off your personal individual assets from what occurred inside the business. And for a lot of clients, that provides them with peace of mind.
Yeah. And another thing, I mean, we're talking about what happens in case somebody's sued, in case that doesn't go well, in case there's a judgment. But what it also allows, and this is something I'd like to hear a little bit more about, is it also creates a separate entity of sorts that can then survive past the original founders. Because if somebody has a sole proprietorship or partnership, and one of the key person or one of the key people die, what happens then? And then in contrast, what happens when you have an LLC or a C Corp that can exist thereafter?
Yeah, it can be a real mess. And, we see it happen a few times a year where I think you have the initial planning of setting up the business, and then once things are going well, doing some long-term planning. And that, takes a collaborative effort of a business transactional attorney and your estate planning attorney. And what you want to do is, for a lot of our clients, is put their shares, maybe it's not owned by themselves as individuals, but if they set up a trust, the trusts are actually the owners of the equity. And so when you pass on, it's a very smooth transition process for however your beneficiaries are designated in your trust. Your business is one of those assets that they inherit. By contrast, if you don't do that advanced planning, there can be uncertainty among the business owners that can lead to conflict that hurts the business. or if it's not placed into a trust, it has to go through probate. And so your ownership interest in your business is locked up for 1 or 2 years as it works its way through probate.
So Doug, what are the costs of an LLC corporation?
Well, I think, anyone could set it up for their business, but I think it's really thinking through, like, is it the best fit for them? And, a big consideration is costs. And what do I mean by costs? And really, if you're a sole proprietorship now, you should be anticipating 3 additional costs for setting up a legal entity. The first is that in California, we have this annual franchise tax. For the privilege of doing business in California, we have to pay at a minimum $800 each and every year for doing business in California. So that's going to be a cost you're looking at. Depending on what type of entity you set up and whether you make any tax elections, you may have to pay your CPA to file a separate tax return. And so if you are a sole proprietorship and you elect to be taxed as an S corporation, you might be paying your CPA $1,500 to $2,000 a year to file that separate S corp tax return. And then lastly, for tax reasons that we can get into if you like, is that you may put yourself on payroll as a W-2 employee of your S corporation. And so you have to pay to process payroll, and that can run $50 to $100 a month, depending on who your payroll processor is. And so you add up those expenses, you very quickly get to about $3,000 to $4,000 a month a year that are extra for a business owner that is now an S corp that makes that transition over to being an S corp.
So Doug, certain people with specific business licenses or specific lines of work are not allowed to have an LLC or a C corp. Can you speak more to that?
Sure, I'd be happy to. So California has decided that certain types of industries are different than other types of industries, and that they shouldn't be allowed to be an LLC. And so the general rule is that if it requires some sort of state license, more likely than not, you're not going to be able to be an LLC. So for example, doctors, lawyers, we can't be an LLC. Instead, our options are a professional corporation. For a lot of our clients to set up a professional corporation, they can elect to have that tax as an S corporation for some of the reasons we discussed earlier. Or if you have multiple members, you may instead be an LLP. And so if you have a state license, one of the things that you should check in on is, can you actually be an LLC, or do you instead have to be a professional corporation or an LLP?
Perfect. So that limited liability partnership, that's a part of a longer chain. So if I would, or if I may, I'm going to just kind of talk about a little bit of the lifeline of a business that's getting started, and then we'll just talk about the key decisions that would lead them in one direction or another. And I'm going to go ahead and frame this before I say this. This is just an overview. This is obviously not legal advice, and this is just helping somebody think through the process that ideally will lead to talking to somebody like Doug and his firm to make sure that they then proceed accordingly and properly. So here, I guess, is the first step. So when somebody starts a business and they're looking to actually transact, they automatically have a sole proprietorship if it's just them. They automatically have a partnership if somebody else is working with them, correct?
Yeah, that's right. And then the requirements are very minimal. So if you're in San Francisco and you're doing business more than 7 days a year, you're required to get a city business license. And so if you're a sole proprietorship, if you haven't done so, you should get a city business license. And then if you're doing business as something besides your personal name, you should also file what's called a fictitious business name statement with the county and a publisher. So those would be the 3 requirements if you're a sole proprietorship doing business here in San Francisco.
Perfect. And if you're outside, is that San Francisco County? Outside of the county, it's different then?
Yeah, so each city and each county has different requirements. So each county, you should expect to have to file that fictitious business name statement if you're doing business as anything besides your full legal name. Some cities have a city business license. That's the majority rule, but some don't.
And here's a key question that I get asked all the time. Sometimes people say, oh, well, I'm not actually from San Francisco County. I'm just doing business there. Where's that line drawn? When do they need a license? When do they not?
Yeah, well, everyone wants to get paid, right? So if you contact the SF tax collector's office, they would say, even if your base of operations is in Burlingame, if you're transacting business in San Francisco more than 7 days a year, we expect you to register with us and to pay us. And really, there's 2 things going on there. One, they want to know who's doing business in San Francisco. So they have kind of a database of who's doing business here. And this is a revenue generator for the city. And so the way they've written the rules, the threshold for having to register is relatively minor.
That's good to know. So it's better to be safe than sorry, because like you said, that's something that could contribute to piercing the corporate veil if they don't have that license. So step 1, sole proprietorship, partnership, that's pretty established. Then you talk about there are essentially 3 different things that lead to moving towards a more structured LLC, LLP, C Corp, and then there's the decision of S Corp, which we'll talk about in a second. It's if you have that big scare. So that big scare often results in, I assume, maybe somebody getting a letter, maybe a cease and desist, maybe just being afraid that somebody might sue them, a really unhappy customer where you've tried those things prior to help make them happy, but they're still threatening litigation. The second one being taxation. Just your CPA essentially says, or you say to the CPA, I don't like being charged essentially 50, 60% taxes of what I've been earning. Let's talk about alternatives. And then the third one is adding somebody to the team. And I want to be clear here too, is this adding somebody to the team as an employee, adding somebody as a partner, or both when it comes to transitioning to a more formal entity?
Yeah, it could be either one. It's really when you're looking to give someone, a piece of the ongoing equity interest in the company. And a fourth and last one that I'll add is that you're looking to raise investment capital. And so investors aren't looking to write a check to sole proprietorship. So if you're looking to raise capital, whether it's a restaurant, a bar, a startup, you're going to have to form a legal entity to bring that capital in.
Perfect. And then I guess one other thing that we could say kind of informally that you said worked really well, but this is more the decision of classifying yourself as an S Corp, is when you start earning a certain amount. I think the number that you said was $70,000 a year net. So then it makes sense to go from maybe an LLC that's just being taxed as an LLC to an LLC being taxed as an S Corp, or a C Corp that you'd like to be, perhaps if you're an individual and you want to be more protected, you have the C Corp that's then taxed as an S Corp. Do I have that right as well?
You do, and really the key reason for that is because when you work for somebody else, you're used to them paying half of the employment taxes. They're paying for half of Social Security, Medicare, and Medicaid, and you as an employee pay for half. Well, when you are your own business owner, you're both the owner and the employee, so you're paying both halves of those employment taxes. And so before you get to any sort of state and federal income tax, you're paying roughly 15.3% in Social Security, Medicare, and Medicaid taxes. Around 125, Social Security drops off, Medicare, Medicaid continues indefinitely. But long story short, your effective tax rate can be 50, 60% here in California if you're just being taxed as a sole proprietorship.
I love it. So here's a question that I get a lot as a coach, because people often feel like a smaller model is restrictive, and it effectively is, as you just described with that math. Well, let's say you have an LLC or an S Corp that's being taxed as, or C Corp that's being taxed as an S Corp. What's the limit? What's the ceiling? I mean, can you have a business of that size, perhaps an LLC that's earning $1 billion in revenue?
Sure, absolutely. And it's really, at that point, it comes down to the factors that, kind of drove you into deciding to be an LLC. Do those continue to be the deciding factors for the best legal entity for you? Or have things changed in the business where you want to instead convert that LLC into a corporation? And so, probably a dozen times a year, we make those conversions for clients because either, they got bad advice on the front end, so it was never the best fit for them, or things have changed in their business, they now want to be a corporation instead.
I love it. So if somebody goes through that sequence that we described, they then have a business model and ideally also an attorney like yourself that can advise them on what to do as their company grows. And they can just get to work and just grow the business. Let's say, and we said we would talk about it, and it's a good stage to wrap up, is let's say they're done. Let's say they maybe want to retire. They'd like to hand the business off to somebody else, although that is a different transaction. But how do you wrap up, essentially close a company like that? And then also, how do you transition it over to somebody else?
Sure. So the first question really is timing. And what I mean by timing is that, someone calls me, early in the year. So, by all means, we can wrap up the entity now. But a lot of your costs for having the entity are calendar year costs. If you wrap up an entity in April, you still have to pay that, and it's made a tax election. You still have to pay a CPA to file that separate tax return. You still have to pay the annual franchise tax here in California. So the bulk of the expenses you'll still have to incur for that year. And so maybe you want to take a few months and really think about, maybe this new job doesn't work out and you're back to doing your own thing again. Maybe you can use a legal entity for other purposes. And so maybe you want to wait till October, November to wind down that entity to give yourself some more time to make sure you actually want it to be wound down. When you've really made that call that it's time to wind the entity down, essentially you go through the reverse actions you did to set up that entity. First, you have to have some sort of written consent of the owners, getting that amount of approval to wind the entity down, and so having people sign off, yeah, we agree, it's time to wind this down. And from there, you go through everything you did to set up the entity, you unwind it. And so you cancel your city business license, for example. You make a filing with the Secretary of State's office to cancel the entity. You go in reverse of how you set up the entity to wind it down.
I love it. And then how can somebody transition the ownership of an LLC or a C Corp to somebody else?
Yeah, there's two ways to do it. The first way is to transfer the equity, doing an equity transfer agreement from one person to another person. Typically, buyers don't like that for the most part. And the reason why is then they're responsible for that entity. And who knows what happened in that entity before the closing date. And so on the buyer side, typically what they instead prefer is what's called an asset purchase agreement, where the buyer comes in and says, I just want to purchase these assets in a new legal entity. I want to make it very clear that anything happened before the closing date, that's on the seller, that's not on me.
Fantastic. So one of the things that I love about Doug's firm and Doug's work, and you have a fantastic team of people, and who knows, we may even have interviews with them eventually too, is that you have a structure that's really conducive for small businesses getting set up. It's not some open-ended, we're going to charge this much by the hour, and it might be 3 hours, might be 30 hours. It's more of a package. Can you tell us more about the packages that you provide to businesses as they set up these initial legal entities?
Sure, I'd be happy to. So we have what we call a no surprise invoice rule. Now, I'm a business owner, and I don't get upset at too many things. But one thing that does upset me is when I get an invoice I don't expect. And so we really don't want our clients to get an invoice that they're not expecting. And so a lot of the work that we do is on a flat rate, including the formation work. And so for a client, what we do is we help them select what entity is the best fit for them. We have a proposal outlining all the steps for setting that entity. We have a flat rate for our legal work and the anticipated government filing fees. And so someone that's going into setting up an entity, they know exactly what they're going to pay to have it formed.
Yeah, and that's really nice because in the beginning, I mean, some people, and this is something I really, really want to caution against. I see this a lot, is some people say, you know what, I'm just going to do it on my own, or I'm just going to wait until something happens. And that is really choosing a pound of cure instead of an ounce of prevention. But what I really love is that it's just so easy to know what's possible for somebody like you, because you build 50 of these a year. I mean, how many have you built over your career? How many business structures? You do 50 a year?
Hundreds. Yeah, hundreds and hundreds.
So you know what the process looks like, and you can just take the guesswork out of the equation, make sure that everybody does things right. Because like we talked about in this conversation, there are certain things that can be really ugly if you do something wrong. And as founders, we didn't go to law school. We aren't CPAs. We don't know that checklist of things that need to happen, things that can really hurt us later on. So it really is a tremendous payout, especially doing business here in San Francisco, especially doing business in California, just to make sure that we have that support. So I can't encourage something like this enough. So can you tell us a little bit more about what are the next steps? If somebody's looking to get some advice, if somebody maybe isn't even sure of exactly what they'd like to do next, do they have to have their mind completely made up of I'd like an LLC that's going to be an S-Corp? Or can they just come to you and your firm and have a conversation to see what's the right fit?
No, they're welcome to come to us to have a conversation. And when people are referred by people we know, and certainly from you in this program, we don't charge any sort of consultation fee for that first meeting. And so I encourage people, if they're thinking about making that step, let's chat. And I can help you work through the analysis. And I grew up in Nebraska, as I mentioned before, and just very honest with people. And so when I think that equation isn't working out, I'll let them know. Say, hey, look, I don't think you're kind of at that threshold yet. Here's what you need to be thinking about for when you may want to make that jump. And if you have an entity in place, we're happy to do a small business checkup to kind of talk to you about, okay, when you form the entity, did you do these things? And if not, if you want our help, this is what it costs. But at least then you have a check-in to say, okay, maybe I didn't do everything right. Let's fix it now moving forward.
So I think one of the biggest calls to action after watching this video is if somebody has a sole proprietorship or partnership that's netting more than 75,000, or even just an LLC or C Corp that's netting more than 75,000, that might be time for a good checkup. That might be a really good time to talk to you and see just, okay, are we doing these things right? Are we protected? Are we properly utilizing structures like perhaps the S-Corp election? And can we just make sure that we're taken care of? Ideally, they have that checkup and they're completely taken care of. But just in case they're not, that's something that could have a huge return. It could be preventing a lot of pounds of cure later on. So one last really important question. We've talked about forming businesses, and I know that's not all that you do. So what are some other things that you and your firm can help with that a business, as it's going along that growth trajectory, should keep in mind to potentially utilize your firm, or just know to talk to an attorney in general?
Sure, we do a lot of contract drafting and negotiating, and our approach is very different. We negotiate with hundreds of attorneys, and what we see there is often they're putting a lot of red ink on a contract that, at the end of the day, it doesn't matter that much. When we're negotiating a contract, it's often, if I'm signing this contract, what would make me nervous? Or are there things that we can add in the contract that benefit both parties? And so a lot of contract drafting and negotiating. We do a lot of raising capital for clients. So if people are looking to raise capital, that's something we work on quite a bit. We help buy and sell a lot of businesses. So if you're looking to sell a business or buy a business, that's something we can help out with. And then lastly, we file over 100 trademarks a year. And so if you're looking to, you've been in business for a few years, you love your name, you're looking to enhance your brand protection, that's something we'd be happy to chat with you about.
I love it. And actually going backwards, let's say somebody has something that they're not really sure that they should trademark. That's a conversation they can have with you. If they're looking to raise capital, is that something that you can just help them really dot the I's, cross the T's, and have the legal component, or can you actually advise them on what are some good avenues to consider as they look to raise capital?
Yeah, we're happy to do both. And of course, if they're looking for guidance and how best to raise capital, they should talk to you as well. So.
I love it. Well, one of the things that I really enjoy from relationships like this is there are conversations like that you can just pick up so that I can have other conversations with them. So I think that's a really great summary. I'm so glad that we could go in this. This was fun. This is really exciting because I think this stuff is unbelievably important. And I've seen so many times that when for a business owner, this stuff clicks, then it just becomes something that, like you described, when you have the insurance, when you have the proper structure, when you have a contract that's really properly set up, you can just relax, you can sleep better at night, and you can go back to what you do best. So Doug, thank you so much for providing that to the people in my networks. Thank you so much for doing that in this conversation. And thanks for what's ahead. I really appreciate you taking the time.
Thank you for having me.